Hello, good afternoon. I'm Omar Akedi, an assistant professor at the Saudi Business School here in Barcelona, and welcome all of you to this session on financing the green hydrogen revolution. And I would say that revolution is quite the right word, as in order to meet the targets in terms of gigawatt of green hydrogen capacity, what we'll have to do is to doubling the installation of electrolyzers over the next years by 2030, 9 consecutive times. So in order to achieve this target, what we need is a massive and unprecedented amount of investment and financing in the amount of hundreds of billions of dollars. For instance, in South Africa alone, just a few days ago, the plan that announced in order to foster a sustainable green hydrogen industry would require $14 billion. And on the top, it's not just massive and unprecedented amount of financing, but also an unprecedented speed in order to deploy and being able to speed up financial closure. So in order to address and try to find an answer to these multi-billion dollar questions, I'm very thrilled to be here with an excellent set of panelists. Let me introduce them one by one. So there's here with me Karim Badr, the CEO of the Utilities and Infrastructure, the sub-fund of the Sovereign Fund of Egypt. Christopher Dahlberg, the CFO of Aker Horizon, a leading planet-positive investment company. Sonja Butzengeiger, the managing partner of Perspective Climate Group, a leading international boutique consulting firm with 25 years in experience in climate and sustainability services. And finally, Keith Staffley, the vice chairman and global co-head of sustainability and corporate transitions and city. So I think in order to start, what we can do is I could ask directly to Keith to have a perspective of what city has been doing in order to scaling up the green hydrogen projects, and also how you can deal in order to make sure that eventually all this financing go to truly sustainable projects, and to what extent the green hydrogen standards that have been introduced just yesterday could be helping substantially your life.
Good, thanks, Omar, and thank you for inviting me to join. Well, just to put this into context, so Citigroup, obviously a US-based bank, we're the second largest lender to the energy sector globally, which means we're the second largest lender to the fossil fuel sector globally. We're a top 1, 2, or 3 financier through the capital markets to the energy sector. We're a top 1, 2, or 3 M&A advisor, strategic advisor to companies in the energy sector. So you can see that we're heavily committed and exposed, if you like, to the fossil fuel industry, but more particularly to the energy that we all need. And there was comments made earlier on about the growing, obviously, population. We're heading towards, 10 billion people. 70% odd of that population growth is occurring on the African continent. And obviously the energy footprint of the average African versus the average Australian, Western Europe, American, Canadian is a tiny proportion. So the quantum of energy that we need in the future will be increasing rapidly in accordance with growing wealth and growing population. But in addition to that exposure, lending exposure and capital markets exposure to the energy sector, we're also probably the world's most global bank. We've got operations, people on the ground in 95 countries, which means we are very, very committed to the emerging markets. So this is all very, very important to Citigroup. I think to best answer the question, there's 2 major initiatives underway, which requires a lot of collaboration amongst banks and other investors. The first, I'm sure many of you heard about, is this acronym GFANZ, which is the Glasgow Financial Alliance for Net Zero. It's a very important commitment amongst now in the order of 200 to 250 banks, asset owners, asset managers, insurance companies, and others in the financial sector. Frankly, it's something we should have got going the day after the Paris Agreement was signed back in December 15, but it took years to get this organized. But what it really is now is combined assets under management of in the order of 130 trillion. So that's around 40% of global capital that's committed to net zero in our financing activities. It's what we call scope 3. It's not so much about our scope 1 and scope 2. The big impact that we all have from a financing perspective is where we put our money. And it's a significant commitment because it really is not just net zero by 2050, but we all know that it's this decade that's the most important in order for us to achieve net zero by 2050. So in accordance with a 1.5 degree trajectory, it's making commitments to shift our capital to ensure that we are aligning our financing to 2030 targets consistent with 1.5 degrees. So we have effectively in the last now 10 months, 11 months, we've calculated loan by loan, client by client, the fossil fuel intensity or the emissions intensity of our lending activity. And you can imagine just how much work that is. But that's our baseline, but most importantly is make that commitment or target out to 2030. And that's aligned with one of the scenarios, which is the IEA Net Zero 2050 scenario, which is in accordance with 1.5 degrees. So what that means is we've made that commitment effectively for a 29% decrease in absolute emissions embedded in our financing activity to the energy sector, and a 63% reduction in the energy intensity in the power sector. Now, what that means is if all banks and all asset owners and all asset managers made the same sort of commitment at that level, it will be a forcing mechanism for all that finance to shift and to work with clients, with companies in the energy and power sectors and the other sectors that we're starting to work on to drive down the emissions across those sectors. Now, at the moment, there's still a big gap between the top of the house commitments versus on the ground decision-making. So we need to make sure that is accelerated. We need to widen the membership. We need to get, frankly, all banks and all investors to be making these commitments. And also we need to improve the reporting. At the moment, we found about 20% of clients were actually measuring and reporting their scope 3. So therefore, how could we do it? Well, we had to use external data sets for that. So what we need to do is all these companies need to be measuring their scope 3 emissions. And that will hopefully give us the integrity that you're touching on. So I'd also like to, just in terms of transparency, the whole effort to bring together the standard, the green hydrogen standard is consistent with that transparency. Unless we have that information at our fingertips, we have to know the emissions embedded in our financing activities, just like we have to know the emissions embedded in hydrogen. That is a critical element for us to make decisions, to drive down the emissions in our financing. And ultimately, that whole transparency has to continue to improve across the value chain. So there's sort of two key elements. It's the whole GFANZ commitment, that's Citi, but working with other banks. If we were just doing it ourselves, we're just giving market share away to others. So it's critical that it's a collaboration. And secondly, transparency in that whole value chain. So we have to know as consumers, as customers, what we're buying, whether it's the emissions embedded in the steel, in the cars that we buy, or whatever products and services that we're acquiring. So thank you, Omar.
Yeah, thank you so much, Keith. Yeah, that's, indeed very important that this effort has to be done not only by Citi or the banking system in general, but also like in combination with private investors. So for that, maybe I would like to touch upon with Christopher, like what has been like the experience in Hiker Horizons in mobilizing private financing for green hydrogen, and whether you could isolate what have been somewhat the opportunities, but as well as the challenges, the bottlenecks in trying to finance these projects.
Yeah, thanks, and thanks for the invite. I think it's a good and a quite extensive question. So I'll try to answer it in two parts and try to divide our experience in the public market first, and then on the private markets. So on the public markets, we raised 300 million euros to IPO Aker Clean Hydrogen, a Norwegian-based producer of low carbon hydrogen, ammonia, and methanol, with a develop, build, own, operate model. At the IPO, we saw great interest in the company, the business model, and the projects and prospects, and were able to raise the amount of capital we needed. So shortly thereafter, we as you know, we saw quite a severe downturn in the more general renewable markets. You know, the liquidity dried up to a certain extent, stock prices plummeted, and actually the hydrogen sector was one of the weakest within the renewable space. So that has been quite a bumpy ride on the stock exchange, to say the least. And we see that the investors now really prefer larger entities. They prefer shorter term cash flow. They don't have the patience they had. And then again, we also see that from sort of an industry perspective that I think offtake has taken longer to mature than some investors hoped. The actual public funding schemes being realized has taken longer time than expected, and that has, you know, that has and still is hampering the industry. And also, I think we as an industry haven't been able to sufficiently prove to investors that costs are coming down in line with what's needed to compete with the grey alternatives. And on the last panel, I was debated $0.8 per kilo for green hydrogen, and I think we are a bit that's down the line. It's not today, to say it the least. So that's sort of the very short experience on the public market, and that ended us with merging with Aker Horizons, our majority shareholder, a few weeks back. Will be effective in June, and really gives us access to a larger company, a larger listing, and that will be helpful in getting growth capital from the public markets. So that's sort of the first experience we have. And then the second experience is quite the opposite. So on the private markets, we actually see a lot of demand for direct investment into our projects. We see both pre-FID, so that's pre-final investment decision money being available, and also post-investment decision money, meaning taking construction risk. We see infrastructure funds, especially in Europe, being very active in the sector. Private equity funds as well is being active, and we see that as a very good source of capital to scale up not only hydrogen but also other parts of the renewable space. So that's sort of our experience. And then you asked about the opportunities and bottlenecks, and I'll start with the bottlenecks and then take the good stuff towards the end. But one of the bottlenecks we see is a lack of a liquid market for green products like green hydrogen, green ammonia, and green methanol. There is basically no trade today. All the agreements are bilateral, and we haven't seen any large offtake agreements being signed. And that, of course, is hampering the progress, both of, you know, in terms of maturing the project, but also then realizing the funding that is required. So the first bottleneck I would say is that we lack liquid markets, and that sort of is interlinked with the public funding issue. So that's bottleneck number 2. So we see a lot of good talk out there on a lot of billions of euros being committed to help realize the renewable the green shift, but seeing actual capital being allocated to scale up, we don't see a lot of. There's a lot of opportunities to apply for funding for R&D, and that's of course good, but we as an industry need funding to scale up a technology that is largely known today. So that is the second thing I would like to highlight in terms of bottlenecks. And the third thing I would like to highlight is that, of course, it's been mentioned before today, but the lack of infrastructure. We really need to move the green products from where it can be competitively produced to where the demand is. And for instance, for hydrogen, pipelines are the only viable option to get a low-cost transport over some different distance. So that's maybe bottleneck number 3, and I think we will touch upon this later in the panel debate as well, because they are quite important. But then on the opportunity side, we see a very good opportunity in combining public capital with private capital. So having a big company diversified with near-term cash flow is good on the public side, and we have that now through Aker Horizons. And then also on the private capital, there is a lot of interest, as I said. And what we really see as the benefit of private capital is that we don't only get access to the capital itself, but we get access to the know-how. we get access to partners, we get access to connections. It could be off-takers, could be power producers, could be a various amount of things. So we really think that is the way to go to combine these two. And actually the Aker system, which we are a part of now, a few months back announced that they will launch Aker Asset Management as a very big private investor, raising 100 billion euros to invest broadly, but a big portion of that will be likely allocated to renewables, and that will be a potential big source of capital also for us and others with good renewable projects going forward.
Thank you so much. And I mean, you rightly emphasize the role of public-private partnership, and so here maybe I want to go and ask Karim, what do you think would be the role of sovereign wealth funds and like yours in order really to foster and mobilize further private financing?
Yeah, no, thank you, Omar, and thank you for having me on this panel. I think I first need to disclaim that we're a bit of an atypical sovereign fund. Our mandate is to invest in Egypt rather than outside. So that created us to attract foreign direct investment, to entice global investors and developers to come and invest in Egypt. So basically, from that perspective, the sovereign fund looks at green hydrogen more specifically. We took a lead in that angle, along with the Ministry of Electricity and the Suez Canal Economic Zone, in order to position Egypt as a green energy export hub in the region. And I think that's extremely important because we are capitalizing on our natural resources, both wind and solar. We also have land availability and the right infrastructure, which is an important element when it comes to network, transmission network, when it comes to ports. And then thirdly, accessibility to Europe, being on the Mediterranean and so forth. So we have successfully signed a number of MOUs with a number of developers to come in and create these mega projects in Egypt. And we look forward to cementing these projects in COP27 in Sharm el-Sheikh by end of this year. So when it comes to the role of the sovereign fund and the financing, I think we play three main elements when it comes to that. Firstly, we are an equity investor, so we co-invest alongside the developers. We come in post-FID, so we take construction risk, but we don't take development risk. And I think that's important because we help with fundraising. We become the partner of choice that we aspire to be to these developers, making sure that we're them for the long run. And then secondly, our equity presence makes us also a vehicle for these projects to access donor funding, to access cheap financing that reduces the cost of funding and also improves project economics, which is extremely important in this early stage. And then thirdly, we work closely with these developers in order to put together the right incentives from the government in order to make sure that these projects are economically feasible and attractive to position Egypt in that sense. And I think we're hoping that this is the right formula. We've seen a lot of the big players come into Egypt, especially with the green hydrogen, because of the natural resources that I spoke about. And we look forward to cementing these things in the future. Thank you.
Yeah, thank you. We also look forward to see similar kind of experiences like one of the sovereign fund in Egypt in other countries as well. And I mean, until now, I've been thinking about the role of banks, private investment, private and public partnership. But I'm a true believer that in order really to achieve this decarbonization of our economies, a key role has to be put into the development of well-functioning carbon markets. So this is a key area. And so I wonder whether Sonia could talk about, I mean, how you see what is the role of carbon markets in this sustainability transition, especially in fostering green hydrogen, and how what are the actions that you think we should be doing in order to push them and develop them more and more?
Yeah, thanks a lot. So maybe just 2 words on my company first before I then answer your question. Actually, Perspectives has been consulting both private sector and also the public sector on climate policies and also on implementing carbon market projects over the last 20 years. And over that period in time, we have seen quite an evolvement of the nature of the carbon market mechanisms. So one started off with a very project-specific approach that then developed over into a more programmatic approach, and then it has been even growing a bit further into national programs. Now, with the Paris Agreement, we enter into a new era again, which is basically that there is more commitment on the countries' side, so to speak, but at the same point in time, we are currently lacking their concrete incentives for the private sector. And now, having worked on carbon markets over the last 20 years, I'm really convinced that carbon market mechanisms can play a vital role in financing green hydrogen and also low carbon hydrogen projects, because what you basically do is, and I just explained for those that are not so familiar with carbon markets, you look into the question, if I have a green hydrogen project, for example, and I produce the hydrogen, say in Egypt, and then I use part of the hydrogen in Egypt itself, and the other part I export to Europe, let's say to a steel company somewhere in Germany or the Netherlands or wherever. So now the question is, how does that help the climate? Essentially, it helps the climate because you move away from other fossil fuel consumptions. For example, in the steel plant, you might replace coal or gas or other fossil fuels. And for example, if you use it for the transport sector in Egypt, just as an example, you would replace diesel or gasoline. So essentially what you do is you calculate the baseline emissions. So this would be your fossil fuel consumption. And you look at what are the carbon emissions of the hydrogen projects. And the difference between this is what you can make to carbon credits. And then you can sell the carbon credits on the market. There are different markets around. I will touch upon this in a second. And then the market pays you, a premium for those carbon credits, which basically means that you can integrate carbon finance into the overall project finance. And this can be more or less relevant. It depends, of course, on the prices that are being paid. In the past couple of years, we have seen comparatively low prices on the voluntary market, somewhere between 5 and maybe 25 euros per ton of CO2. But the forecasts also are that this will increase also with an increasing level of ambition. So that can be up to 50 or 60 euros per ton of CO2. And then in other carbon market segments, such as the EU emissions trading scheme, we already have reached the 100 euros per ton threshold just shortly, a couple of weeks ago. But I think constantly it's somewhere between 70, 85 euros. So you can see from that there is a significant potential financial contribution. And now the question, of course, is, what do we need to do in order to really benefit from it? And from the discussions I have had, with project developers last year, I realized, yes, people are aware that carbon finance and carbon market mechanisms are somewhere out there and potentially we can benefit from it, but it's still very far away and it's not firmly integrated into their own efforts to make a project economically viable. Now, the technical challenge is that currently there is no what we call methodology for doing the emission calculation, right? The baseline minus the project emission. So usually there has to be a so-called methodology for that. And this doesn't exist yet. So for that reason, we at Perspectives are currently launching a new initiative that is called the Hydrogen for Net Zero initiative, that will bring together industry players and project developers, and also the key standard setting bodies on the voluntary market, so namely Gold Standard and Verra. The two of them roughly make 80–85% of the voluntary carbon market right now. And under this initiative, we will first of all develop a full set of carbon methodologies so that after they are created, project developers can utilize them and really apply them for their own calculations and then aim for carbon credit generation. And secondly, we will create a stakeholder engagement platform where people can exchange on their strategies for reaching corporate net zero targets and for probably choosing the best market segments that are out there. So this initiative will be launched in the next 2-3 months. And we are still open for new members that would be interested to bring in their green hydrogen projects and contribute to the development of the methodologies, because I feel that this work can really be a large foundation for all future developments, right? Not only for the voluntary carbon market, but then also for Article 6 under the Paris Agreement once it's there. So there's really now a chance to contribute to that. And if people are interested, I'm more than welcome to approach me on that.
Thank you so much, Sonia. And so maybe now I can go back to Christopher. And I mean, you touch upon the concept of this lack of liquid markets and all these different bottlenecks. And I mean, what are the actions? What do you see that we should be doing in order really to being able to foster more and more large-scale green hydrogen projects? So yeah, can you elaborate more on that?
Yeah, sure. So I mentioned 3 things. It was infrastructure, the transparent and liquid market, and then the lack of public funding. So I think both the industry, the capital markets, and regulators really play a crucial role in solving these challenges. So I will talk about these 3 individually. So we from the industry, we need to cut costs. We need to ensure that the cost of decarbonization is low, and we need to ensure that the investors get the returns they need to contribute to the green shift. We also need to contribute with develop and building a project that has a low HSSE risk, that we are kept within budget, and that we are keeping the projects on schedule. And we also need to build a track record on this, because as you know, there are very few large-scale green hydrogen and ammonia plants in the world. So there doesn't exist any as-built CapEx estimate. There doesn't exist any one way of doing it. It doesn't exist an established contract structure and so on. So we have a big role to play in de-risking these projects, both commercially and technically. So I think that are the 3 points I would highlight from sort of the industrial side. And then on the capital markets, we really need to provide differentiated funding for different projects at different stages. So the project will have different kinds of risks depending on where they are, and we need funding options basically from the ID to the operations phase of the projects. And we also see that the capital providers need to both understand and handle the risk. And when I say risk, I mean on the technology side, on the construction side, and the scaling of this. And these risks need to be understood and priced correctly. And as the hydrogen industry is emerging, we see that also banks are on a learning curve here, and it's really key for us to cooperate closely with them, to take them with us on the journey, to make all the risks and possibilities understood as we go. We see that a lot of banks now are building up hydrogen competence in their project finance teams. We think that's really good. That really is a help to us. And we think that project financing will be a key route to go to lift these projects off the ground. And then the 3rd point on the regulators. Regulators need to help this industry with the key challenges, and this could be done on many things. So, for instance, on the public funding side, we see contract for difference. We think that's really key to scale it up. It's really key to help the immature industry getting started, and we need to close the gap between the gray price and the green price, basically. We see Germany kicking off with the H2 Global initiative, really good. We as an industry welcome that. We also know that the UK is discussing similar setup, and that is good, but we need more also from the other European countries, including Norway. So that's on the demand side. And then we also need CapEx support for large scale infrastructure. The infrastructure part is a bottleneck, and it is challenging for the industry to lift alone. And we have seen from oil and gas, for instance, that in the beginning of the industry, we really need the government to step up and take a role in developing this crucial part of the equation. Another way to do it is, of course, to build publicly owned infrastructure and lease it out to the industry. And the last thing I would like to mention is the use of public procurement. So we know that the EU in total and all the countries have a huge purchasing power and purchase for hundreds of billions each year. And we think that's an underutilized tool to help lift this industry off the ground. So I think that are the concrete actions I would like to highlight. There are, of course, many more, but those would be the top ones on my list, at least.
Thank you so much, Christopher. And now instead, I want to touch upon something I've been hearing a lot also in these 2 days. That we hear a lot about this need for large amount of financing for all the CapEx, but also there's a lot of concern about being able to deploy all these funds as soon as possible. And so I would like maybe to ask Keith, what do you think that project developers, what they should do in order not just to get access to funds, but being able to speed up financial closure?
Yeah, it's a key question. I might break that down to 3 more sort of broader responses to that. I mean, I think firstly, and Christopher, you touched on this with the new funds, is we definitely need new capital to be raised, right? Every project and every business has a different risk reward equation. And here we are in this room and amongst all these people trying to create a completely new industry. You know, this is something that hasn't been done before, green hydrogen. And we should be sitting here hopefully in 8 years' time saying we've achieved the 100 million tons. And we should be sitting, hopefully, a few of us, well, sorry, maybe all the young people in the room in 2050, saying that's 20+ % of total final energy consumption. I mean, what an amazing ambition, but it's a different risk reward equation to funding current businesses that have very strong cash flows with no technology risk, no offtake risk, no construction risk. So it needs new capital. Now, what we found in the last 18 months or so is that an enormous amount of capital has been raised for new funds focused on energy transition. So a whole new asset class, energy transition, is different risk, different reward, but also different skills. You know, assessing a brown company to transition to a green business is a very different skill to achieve that. And both as an investor, as a bank, but also the management team themselves. So fortunately, we have seen over 60 new funds being raised in the last 18 months or so, and probably in the order of 30 billion plus. And I can just mention a few of them: Brookfield Global Transition Fund, Beyond Net Zero, the TPG Rise Climate Fund, Generation Just Climate Fund. So they're looking for these sort of opportunities. Now, this is broader about energy transition, but obviously includes hydrogen as well. So we need more of that. Now, there's no shortage of capital out there. What's the shortage of is the capital in the right pockets. Now, we've just been advising or underwriting DEWA, which is the Dubai Energy Electricity and Water Utility Company, on their IPO. We raised $6 billion. It was 37 times oversubscribed, right? 37 times oversubscribed. And that was in difficult markets. So you can see there's plenty of capital, but of course that is a strong cash flow business with low technology risk, but they have a very strong energy transition story. So number one is new funds deliberately focused on a business like or an industry like green hydrogen. Secondly, and this was touched on earlier on, we have to face that we are up against all the subsidies in the fossil fuel industry in the order of $400 billion per annum, right? So there's 400 billion going in to directly subsidize. It's more than a mature industry. This is meant to be a declining industry. Now, the whole economic theory of subsidizing an industry that is meant to be in decline is just completely inconsistent. It's the reverse. The economic theory is you subsidize a business that for common good needs a kickstart from governments. So we need to definitively reduce those direct subsidies, and this is direct subsidies. It ignores in the order of $6 billion of indirect subsidies, which is the externalities that the fossil fuel industry generates. These are negative externalities. So that means banks, investors, we have to play a stronger advocacy role with governments. We need to be advocating to governments to reduce, if not eliminate, those subsidies and switch them towards the green hydrogen sector. Thirdly, what I'll touch on is, and I know this was discussed in an earlier panel, it is, the belief and the confidence that we can actually create what we're talking about is really critical for capital flows. I'll just give you a simple example. We've recently been advising GIC, which is the Singapore Sovereign Wealth Fund, on investing in Climeworks, which is a Swiss-based direct air capture company. So it's not CCS, this is direct air capture. Plant in Iceland, capturing carbon dioxide from the atmosphere and then storing it permanently underground. That basically turns into rock when you push it down into those particular geological features. The reality is the reason they raised 650 million for a business that's still a long way away from profitability, right? The first operating plant. But the fundamental reason why it was a successful capital raise is because there was a belief that we have to have this technology in the world, which we do. We have to draw down carbon dioxide from the atmosphere and store it away. So that's the really critical thing. It's a belief and a confidence that this industry will succeed, and that applies to the green hydrogen as well.
Thank you so much. I mean, hopefully it's going to be setting some clear guidelines that are going to help both sides of the market in order to speed up the financing. And going forward, maybe I would like to talk with Karim, trying to really ask you, how would you see, what do you like to ask to banks, investors, and international development banks, how they can help your vision in all the activities that you are, the fund is currently doing in Egypt?
So I think bankability of these projects is a very important element. And what we're trying to do, as Christopher said, everybody's learning. Nobody has, has done this before, really. So I think as we progress, we're all going to work hand in hand to make these projects work. And I think the overall consensus is that green hydrogen now is a reality and the whole world is moving towards it. And it's actually linking export markets like Egypt with demand pockets that previously you could not do that. Egypt, for example, enjoys excess capacity when it comes to electricity. So we had so much renewable resources, but locally we had no use for them at this stage, right? So that enabled us to export this renewable energy in a very economic way and possible way. So from that perspective, I think what we are looking for is the whole financing community to come together to make this a reality. We, for example, are also not just looking at investing our own money, but also similar to what Keith has been talking about, we're also we're taking a minority stake across all these projects, right? And as these project sizes become larger and larger, it's going to be difficult to finance it from our own resources. So what we were thinking about as well is to develop some sort of a vehicle that allows financial institutions, infrastructure funds globally to come in and have an exposure across all the different projects to diversify the risk, but also to help funding these. And I think financial institutions like Citi and others will play a key role to bring together the right pockets into the right projects.
Thank you so much, Karim. And maybe before opening then to floor questions, I want to ask Sonia about, we have been talking a lot about financing large scale projects, but then the limits to finding financing become even all the way more relevant with SMEs and even there, like all the needs for some stable long-term financing become even more challenging. So I wonder, like all the experience, the perspectives, how you can see carbon markets also playing a role in order for not just large-scale projects, but SMEs, and especially even thinking in emerging economies to being able to scale up and to finally deploy their green hydrogen projects.
Yeah, thank you. I think this question is really relevant. And as I mentioned earlier, we do have different carbon market segments and also different climate policy instruments in a way. So in particular, in emerging economies, I really see potentially a large role for what is called Article 6 of the Paris Agreement, which is basically one form of generating carbon credits. The idea here is rather that countries would be on the demand side, so to speak. And of course, then you will have larger volume of credit demand in a way. At the same point in time, what I personally also see very promising is that it's not only limited to the public domain demand, but that there can also be private entities benefiting from it because they have their net zero strategies, which become, increasingly comprehensive and also ambitious. Now, I think what is important to note is that this is not only any future development in a way, but already today we have some countries that are actively looking, around the globe for certain, Article 6 projects. For example, the Swiss government, they have set up a project, a project purchase program under the CLIck scheme already 2.5 years ago. So they are reaching out to, really find good projects in a way. Of course, they have their criteria, social, economic, ecologic, governance criteria. And they are looking for the projects where they believe they really make a contribution to energy transition. And we have been in touch with them very closely, and they're highly interested in hydrogen projects. Their problem is that so far nobody really has applied for funding yet. And this is what I meant at the beginning. I think we need to bring together the project developers on the one hand side, and then the carbon market experts in a way, because I really feel that the additional carbon market revenue can play an important, definitely not the only role, but it can be an important role in making the investment analysis positive in a way, and then really help to implement those projects. And I would also like to refer what Keith, you said earlier. I think we simply need to get started and then develop the confidence that this is working on the ground, right? And if I build now my dedicated renewable energy plant plus an electrolyzer, and I do this in Egypt, and then I want to export it to Europe, of course, this needs to be proven first that it works. But I think we need to do it stepwise. And last but not least, I think we should not forget that talking energy transition is not like being done within a second. It will take years and decades, similarly as it has taken years and decades to build the energy structures that we currently have. Look at the European gas grid. I mean, this has developed over 100 years. Of course, we need to speed up now, but I think we really just need to get started in small steps, and then the steps will become larger and larger, and then all of a sudden we are really in the middle of the energy transition and not just at the beginning.
Terrific, Sonia. Thank you so much. And so maybe now we can take if there's any question from the floor. I will then move myself. Mike.
So hello. A lot of emphasis has been put on the necessity for the increase in government expenditure. We'll hear with infrastructure, and in other panels, there's been discussion of providing tax incentives and also subsidizing the industry in order to attract this foreign direct investment that you guys have mentioned. However, within the context of Europe, the US and Australia, this doesn't make sense. However, if you consider nations that have a lot of potential in this industry, for example, Latin America and Africa, where they have running on a very delicate fiscal situation with fiscal deficit and also increasing public debt. It's very hard to implement these measures. So what does the panel think? What measures could be used to address this situation and provide alternative sources of finance?
So who wants to answer in a nutshell? Because also then we need to leave. You want to try, Keith?
My very quick answer is a great question. Great question. And in fact, in doing our work on our assessment of our financed emissions, the easiest thing we could do to reduce our emissions would be to effectively withdraw from the emerging markets, right? Because, and that of course would be disastrous. So you're absolutely spot on. I mean, every molecule of CO2 is a global molecule of CO2. It doesn't matter where it comes from. We're impacted. And the reality, as we touched on earlier on, we've got 1.4 billion people in India. I was just there last week. By the way, very excited about the ambition, the vision, and the commitments and the actions being taken by many of the Indian companies. 70% of world population growth occurring in Africa. We need to get capital to those markets. We need to get those emerging economies to leapfrog the development patterns of the West. We need to get the technologies in there, just like in Kenya, the leapfrogging of their telephone mobile network. We absolutely have to repeat that time and time again in all of these emerging markets. And there's a whole bunch of mechanisms we can use, financing mechanisms we use to encourage that. But certainly the mentality, again, back to this point about belief and confidence, is that we have to treat these emerging markets as not just people who deserve and require the energy requirements, but they'll also deserve increasing intensity per capita, but that has to be clean. It has to be green, and we have to develop the green, in this case, the green hydrogen solutions in those markets. India, I think, is a great example. It's actually got plenty of land for solar, for that solar to be used directly into the electricity grid or for the production of green hydrogen for domestic use, but also for export. And what we're going to see is a complete realignment of energy trade routes, because a lot of the renewable energy in the world is actually in emerging markets. So we will see hopefully an empowering of many emerging markets because of their ability to produce and export clean energy through either direct electricity cable or through the production of green hydrogen. Sorry, that wasn't quick, was it? But thank you. It's a good question.
And yeah, Christopher, and then we wrap up.
Just to add on that. So very quickly, I also think it was a very good, insightful question, and thanks for that. So in addition to what you said, I think development banks, they do play an important role and can take even more responsibility. We see, again, German banks, development banks do a lot of good, and they are really supporting with us with local knowledge. They are supporting with connections and also help to fund up this development. So there are things going on in this area, and we also see that the development banks really play a role in taking a bit higher risk than you could see from traditional banks, and that also helps in these kind of areas. And also they can support, with guarantees and stuff, which makes it easier for instance, for European companies to establish plants in those kind of countries. Yeah. Thanks.
Fantastic. Thank you. So I think we need to end the discussion here. I would like to thank all of you, Keith, Sonia, Christopher, and Karim, for this fantastic panel, and all of you for being here. And again, thank you so much.
Thank you.